Hello, and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm TJ Sponsel. In today's episode, we will discuss how to leverage tax planning in challenging real estate environment and discuss the current market climate of key states. Joining us today on Let's Talk Tax is Dave McGuire. Dave is a shareholder of McGuire Sponsel, specializing in fixed assets and cost segregation. Welcome, Dave.
Thank you.
Well, Dave, kind of when we're sitting here talking about some podcast ideas, I think one thing that we're facing sitting here in 2024 is the real estate environment looks a lot different than it has in a number of years. Obviously, we think back to 2008 and the recession and the ramifications of that. Sitting here in 2024, there's cost segregation, which is one of our bedrock practice lines, is still important. It's just maybe not as hot because some real estate transactions are down and such because of current economic factors. But there's a lot of other things that are out there for people that are investing in real estate, people that are investing in energy efficient equipment. And I thought maybe today we could talk about that and the pros and cons of that and where it fits and for what applications it makes sense.
Yeah. I mean, it's nowhere near where things were in 2008. And the real estate market is still good in a lot of ways. It's just transitioned. Is the old school, you go to it, we sit here in downtown Indianapolis. Downtown Indianapolis is not the same as it was 5 years ago. There's less occupancy in the buildings, but yet you go out into the suburban areas and you see cranes and you see real estate transactions going on at a pace that actually outpaces what it might have been 5-6 years ago. So there's this transition, and we really need to figure out where those opportunities are. But as you said, then also for those companies that are used to it, they've got to look at other opportunities. And right now, with the Inflation Reduction Act, as you kind of alluded to, there's money out there that people need to be aware of and how to go out and access it.
Well, I think obviously there's, as you mentioned, there's a lot of markets across the country that are just busting at the seams. I mean, it's not, obviously we talk about Indianapolis, we talk about suburbs like Carmel and Fishers and et cetera. But and you look at other markets out west or down south or on the East Coast that are booming. And so some of those traditional tax planning still exists. Okay, but it's okay. Where do we balance? How do we help educate our CPA firms and saying, okay, these are the things you continue to push on your clients, and these are some other areas that are available that are kind of more unusual or new, and where does it make sense? Because I think so many times, Dave, and we've seen this, with 179D historically and many other things, that there's these catchphrases. It's the newest thing that's being marketed, and how do we assist our alliance partners and help them? Okay, this makes sense for your client, and this could be appropriate, and this is a fallacy. This has no benefit to your client.
Yeah, I mean, what we've seen is the traditional real estate investors may have slowed down a little bit because interest rates have gone up. It's not that the values have changed, but the interest rates have changed, so the value proposition for them has changed. So they might be slowing down transactions. They might be holding on to assets for slightly longer because they don't want to be flipping them right now. But at the same time, the owner-occupied buildings, those are still going gangbusters because we see the growth in areas like manufacturing. Manufacturing in the U.S. is picking up at a rate that is relatively incredible, which we're seeing on the R&D side and other areas of our practice. And so those companies, they still need places to put their equipment. But then also, as we'll talk about later with the IRA, there's changes even there where we're seeing people wanting to go after battery technology because of the credits, seeing people want to invest in wind turbines, in solar panels, et cetera, because there's so much money out there right now being pushed by the federal government that people need to be aware of.
And it's kind of being diverted because obviously with the changes of 179D and 45L up through 2022, that was a really great tax planning tool for developers, investing in residential real estate, as well as business owners or investors building commercial buildings. Can we kind of touch on the changes there? Because I think for some people, they may not realize the significance of what's different in 22 from 23 and going forward.
Well, we'll talk about 179D first. 179D doesn't change as much as 45L. And we'll take a step back for those that are kind of coming into this blind. 179D is a deduction for energy efficient improvements to real estate. And so that's been around since 2006. It was part of the Energy Policy Act of 2005. So it's been for almost 2 decades now, part of the tax code that people just got accustomed to. And up until the end of 2022, it was a $1.80 a square foot index for inflation. So if you went out and you built a new building, you could pretty much feel comfortable in 2022 that you're probably going to get a deduction of up to $1.80 a square foot. Well, with the Inflation Reduction Act, they changed it significantly. Now, the math for actually determining if you qualify is pretty much the same. But what they did is they changed it from $1.80 a square foot down to $1 a square foot, but then created these multipliers if you hit prevailing wage and other requirements, which basically says if you pay everyone who touches the job prevailing wage, you have interns that are coming on, and you keep all of that stuff in place, it goes up to $5 a square foot. The problem is most real estate investors aren't going out and bidding out their jobs at a prevailing wage rate. They're not going out and saying, I need my painter, my landscaper, my flooring installer to all be prevailing wage and have interns. So most people are not getting that full $5 a square foot moving forward. They did initially because there were some safe harbors in there, but moving forward, they're going to be down to $1 a square foot. So it's not as beneficial. Now, that said, still relatively decent. The other area we see it is with architects and engineers. There is an ability to transfer this deduction, and that was now extended to tax-exempt entities. But that probably gets into a larger conversation
Sure.
on 179D than we have for today. 45L is actually a much different change and actually much harder for a lot of people. So once again, we'll take a step back, talk about what 45L is. So 45L is a tax credit for building energy efficient homes. So prior to the end of 2022, that was based on the IECC, the International Energy Conservation Code, which said if you build a home that is 3 stories or less above grade, so that included apartment complexes, things like that, there was a tax credit out there of up to $2,000 per unit. Now, what happens now, though, is that was based on just an energy savings. So we could go in after you completed building your apartment complex. Let's say you had a 150-unit apartment complex. We could run an energy model, and if all of them qualified, you get a $300,000 tax credit. And developers were starting to rely on that. Well, as part of the Inflation Reduction Act, they changed it. Now, with most people, they go, well, they made it better, right? And this is one of those areas that they probably actually pulled back a little bit too much. So there were 2 changes. First off, for multifamily, they dropped that credit from $2,000 to a base credit of $500. And on single-family homes, they raised it to $2,500. So that's not a huge change. The bigger thing is they changed it from being linked to a energy requirement under the IECC, and now it's linked to something called Energy Star. Now, we all know Energy Star. If you go out and you buy an appliance at Home Depot, you're going to see an Energy Star label. So we've all heard of Energy Star. What we haven't heard of it on is we haven't heard of Energy Star on new homes. You don't go out and buy a new home or rent an apartment and go, is this apartment Energy Star rated? So it's a relatively new concept as it comes to real estate development. The problem with Energy Star is Energy Star requires that you get involved in looking at it prior to construction, because it requires that your engineers have certain requirements put on them. Your HVAC installers have certain requirements. The framing of the building has to be done a certain way to eliminate air gaps, something called a California corner. You have to have a certain amount of external air coming in as part of your HVAC design. Your kitchens have to be exhausted to the outside. So there's a lot of these requirements that developers aren't doing. So if they wait until after they've actually built their facility, the odds of them getting a 45L tax credit are slim to none. Now, we can look at it up front, but the problem is now if you're building an apartment complex and you're looking at a credit that's only $500 per unit, are you really going to change your design to get that tax credit?
Well, I kind of looked at it, Dave, is that it was different. You know, the old way prior to 2023, it was almost best practices. It was what contractors were just using because they didn't have to be intentional to get this credit. Is a lot of times we were bringing up the 45L to them after they've already placed those buildings in service. Now with 45L, you have to be intentional in terms of seeking some energy. Obviously, it's Energy Star certification. It's not just no longer best practices. It's got to be much more intentional in how you design your building.
Exactly. It has to be intentional, and quite frankly, unless there's another market reason, it might not be a good business decision. Mm-hmm. Because if you're just doing it to get the tax credit, you might end up spending $800 to get $500 in credits. And that is not the way you build a business. Now, if there's other reasons to be Energy Star, if the state requirements for building codes start picking up, If there's other reasons behind it, if you can get a marketing, let's say you're building single-family homes. If you can build single-family homes and sell them for more because they're Energy Star rated, then this tax credit's great on top of it. But if you're simply spending $600 in consulting and design and construction fees to get $500 back from the federal government, it's not worth it.
Absolutely. Well, let's talk about some of these other IRA. Obviously, the Inflation Reduction Act was kind of the trigger that changed 45L179D. But what else is out there regarding real estate and energy efficiencies?
There's a lot of things out there. So we'll talk about, as it relates to real estate, the big things as it relates to real estate is the solar credits, things like that. And that's what people think of when they think of alternative energy tax credits. That's typically where people are going. This is very expansive, but where people see it is when you're driving down the highway and you see new wind turbines being put up, or you see solar panels going in a field or on a building. And that's the biggest area right now. And what they did there, and when we're talking about solar panels, I'm going to limit it to talking about ones that are less than 1 megawatt in total output, because there are some additional requirements when we get bigger. But when we're talking about those mid-size systems, which is what people are putting on manufacturing plants, the base credit on those is now at 30%. But it gets better than that, because in addition to that base credit of 30%, there are potential multipliers. There's an extra 10% credit if you're listed in certain energy communities. There's another 10% bonus credit if you're using domestic content. So now people are looking at a tax credit of 30, 40, even 50% on the cost of installing solar panels. But it gets better than that because they still get to get bonus depreciation on it. So if you put in, let's say you put in $100,000 worth of solar panels and you're at a 30% tax rate, and we go through everything and we determine you can get the 40% tax credit. So you get a $40,000 tax credit right off the bat. But then you get bonus depreciation and you get to depreciate $80,000 because you only reduce your basis by 50% of the credit. If you're at a 30% tax rate, that's about $24,000 worth of savings on the depreciation side. So you're immediately getting 64 cents back on the dollar for every dollar you spend on these solar panels. Now, I know there's some more math that goes into the depreciation and everything else, but that's on top. Then there's grants on top of it. There's money for what's called a REAP grant, Rural Energy for America program, which could be up to 50% of the value of the system. So there are people putting in solar systems right now where almost 100% or more of the system is being paid for before they even throw the switch to turn it on. So that's been a huge boon for the alternative energy market. And a lot of real estate investors are starting to look at this because they're sitting there going, I might be slow finding development deals or transactions. If I can go out and put solar or other things on my roof, then all of a sudden that pays for itself and that makes up some of this shortfall.
Sure. Let's talk about the REAP grants. I know it's something we've talked about internally for a few weeks here. Can you kind of tell our listeners about that program?
So REAP grants aren't new. REAP grants have been around for a while, but it's a Rural Energy for America programs. But what happened is this got a lot of funding behind it under the IRA. And what a REAP grant is, it's a grant for certain types of energy systems. And primarily where we see it right now is in solar systems. And it's for rural areas or certain types of entities, even in an urban area, farms, for example, farming co-ops. And that's a grant of up to 50% of the value of a system up to $1 million. So you could see a solar system, if it's in the right area or being put in for the right entity, going in on a $2 million system, and they could be looking at $1 million worth of grants coming out. And that's paid out through the state. So what happens is it's funded from the federal side. That funding goes to the states. Then the states administer the payment of it. Now, what's really nice about it is it doesn't reduce the basis in the system. So what happens is it's actually a taxable grant. So if, let's say you have a farm and you go out and you say, I'm going to put solar panels on my farm. You put $1 million worth of solar panels on your farm. You get a $500,000 grant through the REAP program. Now, you're going to get a 1099 from the government on that. So you'll have to pay back some of that. So let's say you're at a 40% tax rate. You're going to lose $200,000 of it, but that's still $300,000. Now, remember what that math we went back on just a minute ago, where I said 64% was coming back from the federal government if you're in an energy community, bonus depreciation, everything else. Well, this REAP grant just gave you another 30%, even taking into consideration the tax implications. So you just got 94 cents on every dollar back on your solar system before you ever generated a single kilowatt hour of electricity.
So when the federal government's obviously providing the funding to the states, is there a established pool? Is there a cap on the dollars, or how does that allotment work?
So what's happening is the federal government pushes it out to the states, and then the states are actually administering it. So there's an application process that goes through, and that's relatively rigorous, and that's where we come into play, and other providers such as us. So we can go in and we can work to make sure we're getting the application put in correctly to make sure you're getting an aspect of that. Because there is a limited amount of money, and when the money runs out, it runs out. But right now, it's flowing pretty easily to a lot of people. You just have to make sure you've got your I's dotted and T's crossed.
Dave, when we're talking about obviously grants and credits and deductions, there's always this issue of the utilization of actually when it means something. So when it comes to some of these credits, for example, can we talk about how these are utilized and realized by by companies?
So there were actually a lot of changes related to that with the Inflation Reduction Act. So for-profit companies, one of the big changes is now these are transferable. And what that means is you can go out and sell these, and there's markets starting to develop to sell them. So say McGuire Sponsel, as a for-profit company, goes in and puts in $1 million worth of solar panels. And we generate a credit of $400,000 that we can't utilize. We could go out to a market and sell that. And those are selling anywhere from 95 cents on the dollar right now. But as the markets change, that could fluctuate. Where it actually gets really interesting, though, is for tax-exempt, not-for-profit, state and local governments, et cetera. They can actually go out and get a direct payment on the credit. So what happens there is, let's say you're an eligible entity. You're a church. And that church goes in and puts solar panels on their roof. That church can then get a direct payment from the government for the value of the tax credit. And the way that works, that is done through filing a tax return. So it's seen that, let's say let's just take an arbitrary church, ABC Church. They go in and they put in solar panels in 2023. And those solar panels generate a tax credit for them of $100,000. What happens is they have to do some filing with the IRS. There's some paperwork that needs to be filed. And then they file their tax return. Now, they're going to have to wait till 2024 to file their 2023 tax return. And the IRS is going to deem that $100,000 tax credit was a prepayment of taxes. So then they will send them a refund check when they send in their tax return at the end of the year. So that way, even those tax-exempt entities can get the money out. Now, there's a little bit of a timing issue because they have to wait till they file their tax return to get it, but it's still a way to access these fundings even for those tax-exempt entities.
So is this all for solar systems put in place in 23 and beyond, or is there anything available for maybe somebody that didn't know about these programs or came out and IRA wasn't the motivation for them investing? If they put these solar panels in 21 and 22, is there any opportunity for them?
So there are. It's different because the tax credit amounts change. So if you put in solar panels in 21, 22, the amounts of the credits change because this is all under Section 48. Mm-hmm. Section 48 is not new. Section 48's been around, well, I'm not sure how long it's been around, but I know I started dealing with it back in 2001, 2002 timeframe. It's been around for a long time. So now the ability for people to transfer them, take direct payments, that starts after 22. That starts 23 and beyond. But going back, yeah, there are still tax credits out there. An important thing to note is they actually start changing in 25. So solar panels won't be affected. What gets affected is non-electric generating alternative energy systems. So your geothermal systems, your solar thermal systems, things like that. They actually change the tax code section, and it will require that you actually generate electricity with these systems to take the tax credits for projects that start after 1/1/2025. So really what that comes down to is if you're planning on putting in a geothermal system, you want to start that system sometime in 24 to ensure you can get the tax credit when you place it in service in 25.
Okay. Well, obviously, we spent some time talking about how to invest in your building. If you are getting ready to make investments, and how, obviously, with whether it's 45L or REAP, or maybe this REAP grants with solar systems or other credits associated with the IRA. How about a situation where, and I think kind of spotlighting our property tax practice, somebody that's owned the property for some time, they've already done a cost segregation on it, but unfortunately, maybe low vacancies, they're in a situation where they're struggling. So the stress of maybe the bank financing, interest rates, et cetera. Kind of walk us through the property tax. Why property taxes are relevant when you have high vacancies, when you have maybe some financial pressures on your real estate holdings.
Well, so you and I, most of our career, we've been working in federal tax. So we think about it, we buy an investment, we depreciate it in the terms of a cost seg study. And that's been where most people have concentrated. Now, they forget about the other hard costs that are tax-related associated with real estate. Property taxes are a great example of it. Now, what happens in most jurisdictions is property taxes are based on a value. You go out and you get a valuation on your property, and then they charge you a certain percentage of that as your property tax assessment. Now, what people don't realize is you can go in and you can appeal that value that the local assessor gives you. So if they come out and they say, your property's worth $5 million, and you think, it's maybe not, you can go in and appeal that number and potentially get it reduced. And the important thing on property taxes, you can look at different valuation methodologies, and what most states allow you to do is use the lowest value associated with those different methodologies. So you could go in and say, okay, this could be based on a comparative sale. It could be based on the income approach. It could be based on multiple different things. So you have to look at all those things. So in your example, you mentioned lower vacancies. So let's say I'm sitting in an office tower, and I own an office tower in a downtown metropolitan area, and 5 years ago, that was 100% occupied. But because of the new work from home movement or other external pressures coming at me as a real estate investor, maybe I've only got 50% occupancy. Well, the local assessor's probably only been increasing my value year over year. I can go in and actually look at the rents coming in and potentially get a revaluation on my property to reduce my property tax assessment, and that will reduce that property tax bill I have to pay. Now, for a lot of property owners, that can be a big number, and it's a hard cost. It's not something that's associated with taxable income. So you mentioned, let's say somebody's been in a property for 20 years, and they might actually be going through a downtime in their business where they're not having the taxable income. So we start talking to them about cost seg studies. They don't care. You start talking to them about R&D studies or other types of tax planning. They don't care because they don't have taxable income. But you go in and you say, I can reduce your property tax assessment. That's money in their pocket that then they can reinvest it back into their business. They can use for growth-oriented things. But it's a way to get out of that hard cost.
Well, I've been pleasantly surprised, since launching the property tax practice in 2023, just how many of our clients really do have an opportunity for a lower assessment. I think the challenge, though, is that that's not something you mentioned about federal tax, where you have this window to go back and amend returns and things like that. With property tax, there's a finite period of time, and it's depending on the locality in terms of when your window to appeal that assessment occurs.
Yeah, it requires a lot more knowledge of the local area. And so you're correct. It's sometimes there's some property tax areas where you've only got a week or two to really challenge that. When you get that bill in the mail that says this is your new property tax assessment, and anybody who's listening or watching this that's a homeowner knows what that's like. You get that every year, and typically most people just throw it in the garbage because they go, oh, well, when I pay the bill, I'll deal with it, or I pay it through escrow with my bank. So they just put it in the garbage and don't even pay attention. They don't realize that that's when you can appeal it. Now, obviously, we're not talking about homeowners. We're talking about much larger opportunities. But still, that's something you can appeal, but you have to do it when you get that notification.
And having the expertise to know how to navigate that process.
Correct.
I mean, we have a situation right now in North Carolina that we have a client that we are representing. They got denied. They got a denial letter. Well, I forwarded it to our team, and I'm like, is this the end of the story? and they go, oh, no, that's not the end of the story. There's another level of appeals that we can go to. And so the point is that having that knowledge, that local knowledge, is very, very important, and be able to seek that lower assessment, or that at least get that opportunity to have your case be heard and reviewed.
It's important right now, as we mentioned, this is a challenging real estate market. For a lot of investors that were just used to, hey, I go out and I buy a property, I hold it for 3 years, it's worth 20% more, I sell it, then I buy another property, I hold it for 3-4 years, it's worth 30-40% more, I sell it, and keep doing that over and over again. We've seen that slow down a little bit the last couple of years. That's partially due to increased interest rates. It's partially due to the change in the real estate market, where there's less people in offices, strip malls maybe not be as valuable, but there's a move to industrial. And property tax is a good example of this, where now you have to fight for every dollar. But that's also a great opportunity for people to relook at the things that we've traditionally looked at, the cost segregation studies, the other types of analyses that maximize the profitability of real estate. So just because you're sitting there going, okay, I have less transactions, that's not a reason to kind of put everything on the back burner. That's actually a reason to fight for every dollar, because those timing differences that a cost segregation study creates, or the cash flow that property tax assessments create, allows people to offset some of that pain of those higher interest rates, allows them to create those additional transactions, which allows them to grow their real estate portfolio.
Kind of how we like to end our podcast is our rapid fire question time, Dave. So got a few questions for you. What is the most overlooked tax planning tool when it comes to real estate, in your opinion?
I wouldn't say there's one. What I would actually say is the problem that people have is they get fixated on one, and they don't actually spend enough time going, which is the right opportunity. So it could be, hey, right now I've got a lot of taxable income, I need to look at solar panels or something else to offset it. It could be that cost segregation is a great opportunity, or it could be property tax. But it's not a one-size-fits-all, and often people are just always trying to fit that one square peg wherever it goes. And if you got a square peg and a round hole, you got to switch to the round peg.
Well, obviously, you and I both have some gray hair, and we've been doing this a long time. Next month, we start our 20th year of doing business together. Over that time, and obviously we had previous stops before then in public accounting. In your experience over all the years and all that timeline of how things have changed, what do you think the biggest myth is when it comes to real estate holdings, and tax planning?
I think people see it too much as a commodity, and they don't actually look at what is the best opportunity. It's the old tailored solution. They're going and buying something off the shelf, and they just assume it's every single suit, every single pair of shoes is the same, and they don't look at what actually fits. And that's not the way they do other tax planning. That's not the way they hire their CPA firms. That's not the way they hire their law firms. For some reason, with some of these higher end services, they think whatever shows up on Google is good enough. And that creates problems. That often leaves money on the table or other things.
Well, and I think that's one of the things that we've always taken a lot of pride in is the fact that we have a very sincere approach of what our role is within that CPA client relationship. And so we spend a lot of time in our respective practice areas talking people off the ledge or correcting the bad education that a client or CPA got regarding a cost segregation or a 179D or whatever the case may be. I think one of the things that I guess my last point I would want, or my last question for you is what are the biggest pitfalls you see people put themselves and create exposure with when it comes to doing a cost segregation study or 179D? Where the areas of exposure lie?
We see a lot of bad information out there. And one of the biggest ones is land value. Land value, for years, there was always the old school CPA, just throw 20% on and we'll see what happens. A lot of people aren't actually backing that up, and what that does is it makes all the other information that flows through it bad information. So you buy a $10 million piece of property, you just assume that the land is $2 million worth of that. Well, then everything you leverage off of that then is incorrect if that first assumption is incorrect. So it starts with making the right information, but then it's also just don't assume that you've got it handled. A lot of people make the assumption somebody else is taking care of this, and a lot of times we see that's a bad road to go down because sometimes it leaves money on the table for a lot of people.
Well, Dave, thank you for your time today. Thank you for sharing your knowledge. And listeners, thanks for listening, and thank you for watching. Catch us on YouTube at Let's Talk Tax Podcast or at McGuireSponsel.com for all show notes and follow-up from each episode.